And while we're giving them a minute, Corex,
Mm-hmm.
do you have any other funny retail stories from this week?
Um. Hmm. Oh. A bunch of companies that, like, if we're gonna rapid fire out here, that got obliterated after their big run ups. Open and Kohl's.
Okay.
Yikes.
Yeah. Those were some we were watching. There were some really interesting momentum trades this week. And I'm noticing, like, when I'm looking at news on GameStop, all of these tickers get thrown in there like, oh, the new meme play. Like, what is going
Yeah.
on? What?
Well, Opendoor ran up and then over 2 days, 50% down from the high. Like, just nasty rip
It's
back
still
down.
up pretty. It's still up pretty
Yeah. Oh,
good.
yeah. From its
I know
bottom, it's still up good.
Kelly asked me about that at some point when it first ran up, and
Yeah.
The big problem is this company has never had a positive revenue quarter.
what's interesting about it is they took a ticker of a real company from a couple years ago that just got acquired. So I mean,
Yeah.
I think part of the confusion is people think they know what it is, and it's not. It's not the real estate
And
guys
then,
or whatever the old or Open Table or something, whatever it was
yeah.
originally is
Yeah.
now part of something completely different. And
I was confused because I used to trade Open Table back in the day when it was under
That's what it was, right? Open Table, which is now part of.
Kohl's. It had a similar massive spike from $9 to 21 and then retraced all the way back down to 12. It's still holding right there, but we know what's likely to happen next over the next few weeks.
Kohl's' big problem is it's having revenue compression because, like, most of these retail outlets, they're like, people don't go to them that much anymore.
That's what,
But there's a lot of bond traders in it because their real estate assets are actually worth more
Right,
than
yeah,
the actual underlying company.
They do have a lot of standalone locations, different than somebody that's like mall centric, where they're just doing
Mhm.
leases. I think Kohl's either owns or at least has credit leases on a lot of property that's got some
Yeah.
value to it.
And that's the play that a lot of them are making, is that, even if the company dies out and it ends up in, like, not saying that it is or is going to, but, like, there's a lot of downside protection for bondholders because of the real estate assets.
we got KOSS here. It ran up from $5 to $8.59 and then, cratered.
That's another one that I've looked at that and I've never figured out what the magic is behind that company people get so excited about.
I mean, they have good headphones.
No, they're great. They're amazing headphones.
But they're not doing anything interesting with their revenue.
Well, no, that's what I'm saying. I think they're fairly level, aren't they? You can only sell so many $200 headphones.
I think the short interest has been building on it, if I recall correctly. I've had people asking me about KOSS for a long time, saying it was going to squeeze. And I hope, if you're watching today, that you.
Speaking of Kohl's, there was I noticed at the same time had a sympathy rally was Kirkland's, the company I used to be in, and got out with a measly profit. I'm glad I did, because it just kept bleeding down. That's another, almost like, I don't want to make it sound good, but almost like a GameStop story, where they're trying to go digital, they're closing stores, they're having revenue compression, and it's just been painful. Like, they're only profitable Q4. It's that same problem that GameStop's having, where, except they're a home decor store, where they're trying to do some sort of pivot, reduce down their footprint, get costs under control, go more digital. And it's just been not a great day for shareholders because it's just been rough. Yeah, so it had a sympathy rally around the same time that Kohl's had its rally, because they're kind of sort of in that same demo, that middle-aged female demographic. It's a home decor store,
Zachary, we'll get to your question, but I want to put up two other tickers on the screen just to compare that have been retail exciting plays this week, in the last couple months, actually. Quantum, the Canadian biopharma company. This is a no revenue company, but it's a very tiny float, under 3 million shares. And I don't think there's a lot of shorts in this trade, even though they're selling it as a short squeeze play.
Yeah.
It does have a high cost to borrow, but it's because
there's just not that many shares available.
Yeah, there's not that many shares and nobody's loaning them out. So you get this FOMO run up.
talked with people that tried to short it, and they're like, we can't find shares to
Yeah.
short it.
So
Like,
I don't buy that it's a short squeeze play. I do believe the company needs to raise money. That's why they hire social media promoters. Oh, and I want to compare that to the other one, which is Genius Group,
it's melting down all
which
week.
it ran up to $1.92, but it has not had that inflection
More
point.
liquidity.
And mainly, I think because they have a higher share count, 87 million. They're about to get 50 more million shares added on July 30th when the ERL acquisition goes through. And then they have a shelf offering for 900 million more shares. So yeah, GNS is a tougher story. If I was forced at gunpoint to pick between these two, I'd be looking at Quantum. But you know what's going to happen, Corex?
The problem,
people are going to go in GNS because it's cheaper.
The problem I would warn about with Quantum is, since it's illiquid, it cuts both ways. You might get in at a good price, but you may get out at a painful price because there's no one there to buy.
Yeah, I'm not promoting that you play either one. I'm saying if I was forced at gunpoint to choose between them, I
obviously have my opinions. I think they're both scammy shitcos, but again, if you can hold a gunpoint, I agree with Tony. And at the same time, because it's illiquid, you need to be careful about how you enter and exit, because that lack of liquidity is going to cut both ways.
Zachary says, so there weren't shares to short because it's low flow. It is low flow, and it's heavily controlled by insiders and retail who are not loaning out the shares. There's not that much institutional ownership. When you start getting institutions buying it and they lend out the shares, that's when you get the short. So because there's so few lendable shares, the cost to borrow on the shares that are available is through the roof, ridiculously high. And most shorts would just say, unless it really runs up super high, we're not interested. When it gets high enough, you will see them come in. And that's, I think, what happened here from 38 back down to 15.
Yeah.
The shorts got control. They came in. They got control.
You also had some dilution in there too.
Yeah.
And it's what you're saying. You get some waves of selling, and
then
it's a low volume thing. It's going to go down.
What I thought was really interesting is when they made their announcement that they had taken a small position in GameStop in their own portfolio, and it lost 10%. Like, that was interesting. I thought that they could have had people that would come in, but apparently that didn't work out so hot for them. It was a turnoff.
I'll give Kevin a lot of credit. I mean, he's coming up with a playbook that is exceeding my expectations in imaginative things to attempt
be careful on some of those, though,
to get retail excited. But the problem is, in my view, my opinion, this is not a short squeeze stock.
Yeah, it isn't. And on GNS, some of those creative things are something that investors should be careful of. He was talking about how, that companies have the ability to control the shares, and that's correct. But what he was talking about is, selling shares buying back shares at the bottom and selling them at the top. They're basically capping your ability up to the upside. Even if they're giving you a floor at the bottom, it's basically like running the wheel, except you're the person the wheel's being run on. It's like you got to be careful about some of this stuff that he's talking about and read between the lines, or you get gamed.
It goes back to what we started this live stream talking about. You must understand the company financials and their motivations.
Yeah.
These companies have negative revenue or no revenue, and they need to raise cash to survive, and they will use your pumps to announce or effect dilution.
Hey, Tony, I have a curious question. I know you follow a lot more looser tickers than I do, and I saw this because I kind of lurk because I've been following the Wolfspeed bankruptcy and their Discord.
Yeah,
they were promoting the stock LXRX. Have you heard anything about that?
I have not.
It's a It's a pharmaceutical company. They created a whole Discord room about it. So I was just sitting there like, what in the flippity flip is this?
It's gone from 28 cents to $1.10. LXRX. Good Lord, this company looks horrible.
I know, right?
Look at the profit margins, negative 568%.
Is that bad?
Yikes.
Cash,
Yeah.
62 million. Shareholder equity is...
This is all what I expected. I just was wondering if you had an ear to the ground of hearing anyone
No.
else.
They
run this.
have positive shareholder equity and positive working capital at the moment, but
Yeah. When you're bleeding cash like that at the moment is key.
right. That's why I added that. Operating cash flow negative 167 trailing 12 months. What is it quarterly? Negative 43. They have 62 million in cash. All right. So I would say, they got 3 or 4 months of cash left. Let's see what dilution tracker says. LXRX. Yeah. Dilution tracker is saying they have 9 months of cash left. And it looks like they have no open shelf offerings. So
Really? Wow.
that'd be something I'd look into. Why not? Why not? Aren't they trying to raise money?
Right. Especially given the rest of the situation.